Hello, my name's Clint Steele, and in this particular video I'm going to show you a simple application of probabilistic design to new business venture modeling from the perspective of converting uncertainty into risk. Specifically what we're going to be looking at here is the application of Monte Carlo to a fairly simple business valuation model. So what we have here is the model that's been set up for a new venture that I'm analyzing currently as a case study along with some colleagues of mine, and it's a business called SolarX. SolarX has two avenues to generating income and therefore two aspects to evaluating the value of the business once everything's up and running, which we assume is in, say, 3 years or something like that. And that's what this particular model is for. It's not a cash flow statement or anything like that to analyze business growth or how it will get to its base point. This is actually just a first order initial model to see what the business could potentially be worth once everything has basically been implemented and the business has stabilized. So over this side here we've got a valuation based on a small number of car sales, and over here we have a valuation based on the generation of intellectual property. What we then have under each is just a list of all the key sources of revenue and sources of expense that we would expect to have in these businesses. And that's usually considered pretty simple, shouldn't be too hard to do, and you could do that for pretty much any business. But what's being done here that's different is that we're actually generating distributions for each of the inputs. So in this case, we've got a distribution here for the number of cars that we're going to be sold each year. And by treating them as distributions instead of fixed numbers, what we're actually doing here is removing some of the uncertainty. Also, just so you know, the particular Monte Carlo simulator that we're using is one called At Risk. Swinburne, where I'm conducting the research, has been using At Risk for quite some time now, and that's the Monte Carlo simulator we've been using for a number of years, so we always use that one. And so this is an example here of how we have set up a distribution for this particular cell, which is the number of cars sold per year. Now, obviously, it's this one isn't a discrete distribution. It says, we could sell 10.5 cars per year. So it just means in 1 year we might sell 10, and then in the following year we'll sell 11, and then back to 10 again. In case you're wondering how we managed to sell 10.19 cars per year on average. So what we've done here is we've basically specified a distribution based on the entrepreneur's expectation of what they think would be the least likely that they would sell, what they expect to be sort of the 50% point, where they're 50% sure that they could sell more or less than that, and the amount that they think they would sell, the highest number that they think they would actually be able to sell. So we take those three values and then we generate this distribution based on that understanding of the randomness that can be expected in each of the key variables that would determine the valuation of a business. So here we've got the price that they think the car could be sold for. We've got a number of other things in here, such as various expenses, and there'd also be some valuation parameters over here as well, as in what they think the business would be worth given the level of income and things like that. So it's a pretty simple model. The key thing, though, is that we've now got distributions for each of the variables instead of just a set number. Without doing this, all your calculations are basically uncertain. You just don't know how sensitive those numbers might be to relatively minor fluctuations in those assumed values, which we would call the input variables. By putting distributions in, we now actually can say, well, this is the maximum and the minimum, or the basic distribution that you could expect for the valuation of the business. And the valuation of the business is actually this variable over here. Sorry, I'll just get rid of that, where we've specified that as an output. So what we would like to do now is actually run a Monte Carlo simulation to get a distribution for the valuation. We've specified distributions for all of the inputs, but now we would like a distribution for, in this case, the output, which is valuation. So what we'll do now is we'll actually start the simulation so you can see what actually happens. And this is basically the key to Monte Carlo. What you can see happening here is that all of the input variables are now being randomly recalculated. That is, a random number based on the minimum, the median, and the maximum is being generated each iteration, and then the output is calculated based on those numbers. Those numbers are then remembered, and then at the end of the simulation, we now have a distribution for the valuation of the business. With this fairly simple model, we can see that there is a 5% chance that the business will have a valuation of around about $18 million or more. We can also see that there is a 5% chance that it will have a value of something that's negative, in this case around about negative 500,000. That's not terribly useful. What might be more useful is to look at the probability of the valuation being less than 0. In this case, it's around about a 10% chance. So what that means is that with the assumed values that the entrepreneurs have for this business, there's a 10% chance that the business will basically be unsuccessful, because that is, it'll have a valuation less than 0, and you wouldn't bother operating with a business that's worth 0. That means there's a 90% chance that the business will at least end up with some kind of valuation. You could conceivably say that you're not interested in the probability of it being above 0. You might say you want it to be above the initial investment or something like that. That's something else you could possibly do. You would just shift this to whatever value you're actually interested in. For example, let's say you thought an initial investment of $2 million was required. You would therefore say there's around about a 70% chance that you will get your money back or more. But at the moment, I'm going to leave it at 0, because we don't at this stage have a set number for investment that's actually required. And I'm going to leave it at the 0 point and the maximum 5% point. So what we've got now is an understanding for this particular business venture. I should point out that these numbers are being put in somewhat arbitrarily. I think a number of them need to be reevaluated by the entrepreneur. I've actually put them in myself without too much thought, so don't treat these numbers as representative of any particular business out there. But what you can now do is see that by putting the effort into understanding the randomness of each parameter that affects the value of a business, you can now work out the distribution for a business. That particular element of uncertainty has now been removed, and instead of uncertainty, you have a known risk. And that's what the application of probabilistic design, in this case specifically through Monte Carlo simulation, can offer to somebody who's starting a new venture. That could be the entrepreneur, or could conceivably be an investor or somebody like that who wants to know what the risks could be, as opposed to just worrying about uncertainty. Thank you for that. Once again, my name's Clint Steele. I'm an academic from Swinburne University, and this was just a quick video showing the application of probabilistic design through Monte Carlo to new venture analysis.